Have you ever wondered if your entire financial future is resting on a single deck of cards? Imagine you spent 30 years building a house with your own hands, but one day you discover the entire foundation is supported by just 7 wooden beams. Those beams look strong today, and they are the most famous beams in the world, but they are carrying the weight of the entire structure alone. If just 2 of those beams crack, your life work could come crashing down in an instant. This is not a metaphor for a house, but it is the exact state of your retirement account in 2026. In 1720, a man named John Law convinced the nation of France that paper was more valuable than gold. He was a gambler and a fugitive who understood human greed better than anyone in history. He created a bank and promised incredible wealth from a land called Louisiana. He told everyone that the Mississippi Territory was overflowing with gold and riches. People sold their jewelry and their family estates to buy shares in his company. For 2 years, everyone felt like a genius as the share price went from 500 to 18,000. But there was a dark secret that no one wanted to hear. The Louisiana Territory was nothing but worthless swampland. There was no gold and there was no profitable trade happening. John Law was simply printing paper money to pay off the earlier investors. When the truth finally came out, the entire French economy collapsed within 6 months. People who were millionaires on paper became beggars in the streets. The reason I am telling you this story is because history is repeating itself right now. Except this time, the swampland is not in Louisiana. The concentration risk is hidden inside your diversified index fund. If you are 45, 55, or 65 years old, you do not have time for history to repeat itself. You have spent decades working hard and playing by the rules. You were told to put your money in a 401k and buy a total market index fund. The experts told you that this was the safest way to grow your wealth. But in 2026, that advice has become a dangerous trap. The S&P 500 index is supposed to be a collection of the 500 largest companies in America. It is sold to you as a symbol of diversification and safety. But if you look under the hood today, you will see something alarming. Nearly 1/3 of your entire investment is concentrated in just 7 companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. 7 companies are now deciding the fate of your retirement. Back in the 1990s, the top 7 companies made up only 15% of the index. Today, that concentration has doubled. You are not buying 500 companies anymore. You are making a massive bet on a handful of tech giants. If you are 30 years old, you might be able to survive a massive crash in these stocks. But if you are planning to retire in the next 5 or 10 years, this is a risk you cannot afford. Let us look at what happened in the early 1970s with the Nifty 50 stocks. These were the 50 companies that every expert said you could buy and never sell. Names like Kodak, Xerox, and Polaroid were the kings of the market. People believed these companies were so dominant that the price did not matter. Investors poured their life savings into these stocks at any valuation. Then the oil crisis hit and inflation began to soar. Suddenly, those safe stocks were not so safe anymore. Polaroid dropped 91% from its peak. Avon fell 86%. If you bought those stocks at the top, it took you 25 years just to break even. Can you imagine waiting 25 years for your retirement account to recover? For many people watching this, 25 years is a luxury they do not have. The same pattern is happening today with artificial intelligence and mega-cap tech. Look at a company like Nvidia. It is a revolutionary company with incredible technology, but its value increased 10 times in less than 3 years. Revenue grew, but it did not grow 10 times. What grew was the emotion and the speculation of investors. Your index fund is now forced to buy more of these stocks as they become more expensive. This is the opposite of what a smart investor should do. The system is designed to make you buy high and sell low. The financial industry loves this because they collect fees based on the total value of your assets. They do not care if your portfolio is concentrated or risky as long as the money stays in their system. They tell you to be passive and not to ask questions. But being passive in 2026 is an active choice to accept extreme risk. If Nvidia or Microsoft drops by 50%, your entire index fund will bleed. Even if the other 493 companies do well, they cannot save you. This is the math of concentration that no one talks about on the news. So, what should you actually do if you want to protect your wealth? The first step is to stop listening to the generic advice meant for 20-year-olds. You need to implement what I call the inverse concentration strategy. Instead of letting the market decide where your money goes, You must take control manually. Look at your actual exposure tonight. Check your top 10 holdings in your brokerage account. If more than 25% of your money is in 10 stocks, you are in the danger zone. Consider moving a portion of your funds into an equal weight index fund. In an equal weight fund, every company gets the same allocation regardless of its size. This simple move reduces your reliance on those 7 tech giants instantly. You should also look at international markets that have been left behind. Places like Europe and Japan are trading at 15-year low valuations compared to the United States. While American tech stocks are priced for perfection, these markets are priced for reality. Diversification is only useful if your assets do not all crash at the same time. Right now, everything in the S&P 500 moves together. You need assets that are not correlated with tech stocks. This could mean real estate investment trusts that own physical property. It could mean Treasury inflation-protected securities to guard against rising prices. Or it could mean commodities that perform well when the dollar is weak. The goal is to build a portfolio that can survive different versions of the future. We do not know if the tech bubble will pop tomorrow or in 2 years, but we do know that we want to be safe regardless of when it happens. The second major action step is to build an income floor. Many people panic and sell at the bottom of a crash because they need the cash to live. If you have 12 to 24 months of expenses in a high-yield savings account, you are protected. This cash buffer is your insurance policy against a bad market. It allows you to wait for a recovery without being forced to sell your stocks at a loss. When you have an income floor, you can sleep through a 20% market drop. Without it, every headline feels like a personal attack on your survival. Wealth is not built by hitting home runs every year. Wealth is built by avoiding the catastrophic mistakes that wipe you out. If you can avoid a 50% loss, you are already ahead of 90% of investors. Think about the Japanese investors in 1989. At that time, Japan had the strongest economy and the largest stock market in the world. Everyone said Japan would overtake America. But the Nikkei index crashed and stayed down for over 30 years. It only recently returned to the levels seen in 1989. 37 years of zero returns for the people who just held the index. This is the risk of being a passenger in a concentrated market. You must be the pilot of your own financial ship. Stop treating your portfolio like a plant that you water once a year. Treat it like a garden that needs constant pruning and care. Check your valuations every quarter. If a stock has become too large a part of your life, sell some and move it to safety. This is called rebalancing, and it is the only way to buy low and sell high automatically. Most people will not do this because it feels boring. They want the excitement of a stock that goes up 10 times in a year. But as you get older, boring is beautiful. Boring pays the bills and boring funds your vacations. Boring ensures that you are never a gunhnung for your children. The financial industry has spent 40 years convincing you that this is complicated. They want you to feel like you need them to navigate these waters. But the truth is simple. Protect your downside, and the upside will take care of itself. Do not let the ghost of John Law haunt your retirement. The Mississippi bubble ended in tears for almost everyone involved. The tech concentration of 2026 does not have to end in tears for you. Take 5 minutes tonight and look at what you actually own. Count the percentages of your top holdings. And ask yourself, if you are comfortable with 7 companies holding the keys to your future. If the answer is no, then it is time to make a change. It is better to be safe and slightly underperform a bull market than to be right and go broke in a crash. The music will stop eventually, and you want to make sure you have a chair to sit in. Focus on your income floor and your diversification today. Your future self will thank you for the discipline you show right now. Investing is a long game, and the goal is to cross the finish line with your wealth intact. Do not be the person who loses 20 years of work in 18 months. Be the person who prepared, who understood the risk, and who acted before it was too late. Your retirement is too important to leave to chance or to 7 tech companies. Take control of your deck of cards before the game changes forever. Check your portfolio and start building your income floor tonight. This is the only way to ensure your financial peace of mind in the years to come. Stay disciplined, stay diversified, and stay focused on what truly matters.